Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. We bring you the information. You do your own research. Today's guest is a market analyst, researcher, trader, and former hedge fund manager. He's the author of several books, including Alex Krainer's Trend Following Bible, and also the founder of Krainer Analytics. It's Alex Krainer. Great to have you on the show.
Good to be with you, Jesse. Warm greetings from Monaco to your viewers and listeners.
Yes, warm greetings from Novi Sad, Serbia to yourself. I want to start this conversation off with the concept of trend following when it comes to investing. You wrote the Trend Following Bible, so obviously people can read that for the full explanation, but could you sum it up for us and explain what's behind that strategy?
Yeah, it's a very simple concept. You buy things when the price goes up, and you sell things when the price goes down. Uh, of course, putting it into practice is a lot more challenging because we can never predict what's going to happen to a price of anything tomorrow, let alone a week, a month, a year from now, 5 years from now. In fact, after 30 years in this business, almost 28 years in this business, I am yet to find somebody who can generate reliable forecasts about the price of anything. And so, our principal problem as investors and traders is uncertainty, not knowing what's going to happen tomorrow. So you can do all your homework, read all the research papers, analysis, and so forth, and you still don't know what's going to happen tomorrow. And surprises happen all the time. And the only way to make above average return on investment is to take risk. No risk, no gain. And so, the question is how to navigate the markets. And what I learned very, very early in my career is that markets move in trends. And that happened in the late 1990s, when we had the dot-com boom. And at the same time, I was working for an oil trading company. We were trading physical oil cargoes. We had the oil crash from the mid 20s in 1996, 97 down to below $10 a barrel in the beginning of 1999. And that all happened as a nice, neat, almost straight trend. At the same time, the economy was booming, firing on all cylinders. Capital was gravitating towards tech investments, internet technology, and everybody in the industry, everybody knew that oil prices had to go higher. Everybody knew that. Yet for 2 years, it just went down, 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 and down. And I was sitting there as a market analyst, and it was no fun trading when you're wrong completely for 2 years. And then at the same time, we were watching these stocks go higher and higher and higher. And if you'll recall, it was in December of 1996 that Alan Greenspan gave a testimony to Congress and warned investors against the irrational exuberance. At that time, Nasdaq was trading at about 850. And then over the next 3.5 years, it went up to almost 5,000. No, it went up to 5,000. So, and in only the last 5 months of that boom, Nasdaq added 110% fully. So, I thought, like, why are we trying so hard to do all these market fundamentals and supply, demand, all of these things? We don't even know whether the data is true. It's all dated. It's hard to it's hard to put into a coherent picture. And I thought, look at the markets. They're just moving in trends. So why don't we try to figure out what a trend is and then trade that? And so that's what I did. I was working with a team of, mathematicians and software programmers, and we started building a trend following model. And, once we built it, then we realized we don't need to trade oil only. We can use this for any market. And so, that's for me the value of trend following is that if you trade stocks, if you trade bonds, currency, you have to have a certain expertise in the market that you trade. Coffee trader cannot necessarily trade copper, and vice versa. But if you learn how to trade the curve, if you learn how to navigate the trends, then you can trade any market. You can trade equities, treasuries, currencies. You can trade commodities. And so you're much more diverse, and diversification is still the only free lunch in investment speculation. So that's the direction I took. That was in 1997 and 19 between 1997 and 1999, and I've been a trend follower by practice and by conviction ever since.
Hey guys, just a quick break to hear from today's sponsor, Arc Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about Arc SGO and owner Ian Everard. Have bought from Arc, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at Arc Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And does this framework also apply to longer term investing, or is this more of a shorter term time horizon when you're following trends like this?
No, I think it absolutely applies to long-term investing, and here's the reason why. Among trend followers, there's a sort of consensus that markets trend about 1/3 of the time, and it stages corrections, reversals, and consolidation for about 2/3 of the time, which means that you're going to make money in that 1/3 of the time, but you don't know when that period starts or when it ends. So the only way you can do trend following is by always going out there. I always say like trend following is a bit like commercial fishing. When you hit a big school of fish, then you scoop up a big catch, but you never know where and when you're going to find it. And the only way to do that is to go out there every day. And that means that you have to take some risk. You have to accept certain losses in the process, but you have to keep doing it all the time, which implies that the process is for the long term, because you have to keep doing it, and you want to diversify to as many markets as you can cover. And you never know where you're going to hit a good trend. Like over the last 2 years, we had a great trend in cocoa prices. Cocoa was trading forever between $2,000 a ton and $3,000 a ton. Forever. That was cocoa's price range, basically. And then 2023, 2024, it started trending and it hit $12,000. And today it's trading near $9,000. And so that's a big trend, which you can only catch if you were, going long at the right time. So, an algorithm tells you go long, you buy. If the trend doesn't happen, you're going to burn that chip, right? You're going to make a little loss. But when the trend happens, then you should normally be able to make up all the losses that you've accumulated through a trendless period. And so now we have gold trending, silver even a little bit. Gold just reached all-time highs yesterday, over $2,500 an ounce. Silver is much more subdued, but it has trended higher. It's almost at $30 an ounce. And so, you never know how far these things can go. One thing that I've noticed over the past few years is that we've had more and more of these hockey sticks charts where, the price of something just starts to go up, but then it extends into practically a vertical climb. And we've seen that with stocks like Nvidia and Tesla and Alphabet and so forth. But we've also seen it with things like palladium, cobalt, cocoa, many other commodities over the years. And I think that the reason for this is because all these markets are really small compared to the shadow banking system, which is Okay, so let's take gold. Gold, I think if you take the whole market together at current prices, it's worth about $10 trillion. The shadow banking system is about $220 trillion. And so when the price of something starts to inch higher and the market starts to take note of it, it's enough for just a small fraction of all those money managers out there to say like, maybe we need to have a bigger allocation in gold. And then you get a stampede and this asset takes off like a rocket. And so we keep getting that, but catching that move takes a lot of discipline and a lot of patience because you have to keep trading it. And as again, the thing is gonna happen in about 1/3 of the time, whereas the 2/3 of the time you're just doing the work and you're waiting and you're placing your bets, and that makes trend following a very long term proposition. It could be a shorter term proposition if you knew when the trend was going to start and when it's going to end, and then you could say like, okay, I'm going to trade gold now because it's taking off, and then when it hits the peak, I'm going to lay off. But we don't know when that happens. We're entering an inflationary environment. That is, we already have entered an inflationary environment, but now we are entering the second phase of it, the second wave. And last time we had an inflationary decade, which was in the 1970s. Gold price went up 24-fold. So you never want to call the top, as they say. The top pickers and the bottom pickers all wind up as cotton pickers. So we try to not do that.
I would like to get a bit of an explanation on the shadow banking system for those who might not be familiar. I've discussed it a couple times on the show, but I'd like to get your breakdown and how it affects financial markets.
Yeah, sure. Sorry, I meant to explain that because it sounds like a strange blob, but it's not really. It's shadow banking system is the blanket term that encompasses things like pension funds, hedge funds, endowments, charities. It's liquid. It's institutions that hold liquid investable assets that can move relatively quickly, and they can bid up prices of things, and they can also cause panics and sell-offs. So it's a very big blob to keep in mind, and I think it's the reason why we get the market volatility has increased very markedly in the recent years. Why we had such a tremendous sell-off in the Nikkei and the dollar against the yen over the last few weeks. But at the same time, those market moves can create windfalls for investors that are placed on the right side of them.
There's been a persistent narrative about a commodities super cycle. I've spoken to several guests about that on the show who believe that years of underinvestment in the sector, the supply-demand dynamics, everything coming together on a fundamental side just screams that commodities and hard assets should be worth more, and that perhaps we'll see a rotation from overvalued, what they see as overvalued tech and AI stocks into real assets, gold miners, silver miners, uranium, copper, energy, you name it, across the board. What are your thoughts there when you're approaching things from a trend following perspective? Are you just completely discounting any sort of fundamental analysis? Like do you care that, for example, the supply of uranium is nowhere set to meet the demand of all these nuclear reactors up ahead? Or is it more of just you follow this algorithm and you do what it says? Give us your breakdown there and how that applies to the commodity sector right now.
Okay, so in practice, I trade only by the algorithms. Basically, when the algorithms pick a trend, they pick up a trend, they tell me to go long, then I go long. When they tell me to go short, I go short. I do pay attention to fundamentals, however, because I like to understand the broader, how do you call it, the broader context in which everything is happening. I like to understand the history of markets. I like to understand the psychology of markets. But I've read many compelling fundamentals analysis over the years that amounted to nothing at all. So I find that it's pretty much a 50-50 thing. Either they're right or they're wrong, and sometimes they are right and sometimes they are wrong. And very often, even if you read the right analysis, an analysis that gets it right, it doesn't mean that markets start moving in that direction the moment you read that piece of analysis. For example, I read, maybe 15, 16 years ago, Albert Edwards and Dylan Grice put together a phenomenal piece of analysis back at the time when Nikkei was trading about 9,000. And they were like, Japanese equities are a steal. And they were completely right, but they were 2 years too early. And so had you bought the Nikkei when they published that analysis, you would have been losing money for about 2 years. And at some point, you'd be losing serious money. And in that time period, you might think, they were wrong. Look, and maybe you'd quit. Maybe you'd get discouraged. Whereas if you wait for a trend following signal, maybe those exact same fundamentals, which they read correctly, gave a rise to a trend, but 2 years later. And then, the Nikkei took off, and then you made a beautiful windfall. And, this happens again and again. People maybe get the analysis wrong, or they get the timing wrong, or they get the price entry and exit points wrong. The thing with trend following is that you kind of accept that half of your trades are going to be losers, but you're not buying or selling in response to some fundamentals because they make you think that now that's going to happen. They make you think that there's a prediction to it. You buy and sell believing that once a trend sets in motion, it is more likely to continue than to reverse. And that regularly happens. We just don't know when. So we just have to keep plugging in and trading. And so fundamentals, yes, I like to understand the environment. I like to understand how the machine works. I like to understand how the world events influence the market. And let's say that as a hedge fund managers, I found it much easier to discuss these things with people if I understood the environment, if I could talk about markets. Because if you come in front of investors and you say like, oh yeah, like the price crossed the 36-day moving average, and the slow stochastics are in overbought position, that doesn't say anything to anybody. And so you can't. It makes it very difficult to even try to understand how an investment strategy is supposed to work. But in reality, I do only rely on algorithmic trading signals.
So you mentioned that gold and silver could be in a trend at the moment. Are there any other commodities that the algorithm is pointing to that could be either starting a trend or potentially headed into one moving forward?
Yeah, gold and silver were definitely long. We're long platinum, but platinum has done nothing. It's just been range bound for about 10 years, almost 8 years. And so it's been very small moves to the upside. Elsewhere, commodities, I have to say, most of them are in the bear market, and we have short positions, in things like corn, soybeans, cotton. Yeah, frozen orange juice has been good, but, that trend is already quite high. We don't know how high it's going to get. We still have long position in frozen oranges, but it's a mature trend by now. So something that's only beginning and looks like it might go higher, I would say silver. Gold is also, at all-time highs, even though, as I mentioned, inflation might, who knows what happens to gold. It might go to 3,000, it might go to 10 or 20,000. I don't know. If it hits one of these, how do you call them, hockey stick dynamics, then, it's anybody's guess. And so, yeah, for the moment, that's all I see. And I only trade U.S. exchange traded commodities. I don't trade the London Metals Exchange, and I don't really trade stocks. So, that's basically what I see.
So you're basically either going long or short in the futures market. Is that how you trade commodities?
Yeah, correct. And this year I started experimenting a little bit with CFDs, cash for differences contracts. The attraction there is that even though these are synthetic instruments and you're not really trading real stuff, it allows you to fine tune the risk because, to buy a single contract of crude oil futures, you have to buy 1,000 barrels. To buy a single futures of gold, it's 100 ounces. Silver is 5,000 ounces. With CFDs, you can buy a single ounce of gold. You can buy a couple of barrels of crude oil. I think 8 pretty much is the minimum, and so forth. So you can fine tune the risk in denominations of 8 or 1 or 10, whatever, rather than 1,000 and 100 and 5,000 and so forth. You can buy a single bushel of wheat rather than 5,000 bushels of wheat, for example. So, but for me, it's an experiment. I want to see how you can form the risk profile for a portfolio, and then if that risk, maybe at some point form it into an investment product for third party investors.
Very interesting. So tell us which commodities you're short then at the moment. And when it comes to shorting a commodity, what's your general time horizon? Because I've talked to some people, for example, who say, well, I see oil going much lower from here down to 50. Some have even said 20. I had one guest actually say $10 a barrel at some point. But then they said in the long run, they believe that oil was actually going to go much higher than $100 if we look over like a 3 to 5 year time frame, for instance. So when you're shorting a commodity, what time horizon are you looking at?
Okay, so the way I've developed my model, I've done it so that it can accommodate short cycle trends, long cycle trends, and anything in between. And usually the way that works out is that long cycle trends are going to be the ones that stay with the trend the longest, in the sense that it doesn't reverse on just a small correction or temporary consolidation of price. Shorter cycle strategies are quicker to reverse direction from long to short and vice versa. But based on my experience of about 28 years and literally millions of simulations, I know for a fact that the most reliable performers are long cycle strategies. The only problem with them is that they're the most volatile, meaning that, okay, so let's say if you're trading S&P 500 and now it's trading close to all-time historic highs, you will stay long that trend long after it's reached its peak. So, it might be a correction, either a deeper correction or maybe several weeks of price going on the other side before the strategy will register a reversal and tell you, okay, now close these long positions and go short. Whereas a shorter term strategy might do so much, much quicker. The reason why the longer cycle strategies tend to perform better is because they get whipsawed a lot less. Shorter term strategies, like maybe a substantial corrections throws you onto the short side, but then as we just saw now in Nasdaq and S&P 500, and then maybe the market fully recovers, but now you're short, and then by the time it reaches close to the peaks again, then your strategy says, oh no, it's still a bull market, go back to being long. and so, those kinds of things tend to whipsaw a strategy, and then it takes longer to recover those losses. Whereas longer cycle strategies just sit there on the long side, and it takes a while. But on the other hand, they're going to give back more of that trend before they switch sides. Okay, so having explained that, you asked me which commodities we are short now at the moment. So I have to read it off of the thing because I don't necessarily know off the top of my head. So we're substantially short RBOB gasoline, palladium, natural gas, crude oil, sugar, cocoa, wheat, soybeans, corn, and the dollar against the yen. That's what we're short. We are long platinum, coffee, silver, gold. I'm just reading the commodities, not the other stuff. Yeah, that's pretty much it. That's the commodities we're long. Not very many. We're short more of them than we're long.
Fascinating stuff. I want to switch the topic of conversation a bit more to the political, geopolitical realm and talk about the difference between capitalism and socialism, because you wrote an article on the subject for the Peninsula Foundation where you said those who embrace socialism tend to blame capitalism for everything that's wrong with our world today. Those who embrace capitalism harbor a seething contempt for socialists, but both camps base their view on ideology with only vague notions about the true nature of either system. So, what are the main misconceptions that people have about both capitalism and socialism?
Yeah, that's a very important but a very complex question. I'll try to explain it as best as I can. But basically, both camps are wrong. Okay, because of the nature of the monetary system that we have now, you cannot avoid socialism. That is, you cannot avoid government playing a role in the economy. I'll try to explain why. Basically, if you analyze an economic system that, and let's pretend that it's closed, so there's no imports or export. But whether there's imports and export only it doesn't invalidate the analysis because the analysis is mathematically correct. But to make it simpler, let's pretend that it's closed, no imports and export. So let's say that this economic system produces a certain amount of goods and services every year, and these goods and services are put on the market with a certain price attached to it, and so the selling price, the prices that these goods and services reach in the markets are at the same. They are income to the sellers and people who produce the goods and the services, the entrepreneurs, the bankers, and everybody. And at the same time, they are aggregate prices of goods and services that are out there on the market. So it's the aggregate cost of these goods sold and the aggregate income of the system is one and the same thing. It's the same money playing dual role in the economy. Okay, so for a system to remain in balance, then all the goods and services produced should be absorbed exactly at the prices at which they are placed on the markets, because that the sale of those goods is the income to the people who produce them and represents at the same time the total purchasing power that's available in the system. Okay. Now the problem arises for two reasons. Because the nature of our monetary system is such that the purchasing power is systematically reduced whenever somebody pays their debts. So you raise credit to put some goods and services on the market, but you have to pay it back. So that money disappears from the system. So the purchasing power is systematically being reduced. Okay. The second drain on the purchasing power is that people don't normally spend everything they earn on goods and services, right? People always like to put something away for the rainy day. So that money is systematically withdrawn from the economy, and the purchasing power in the system is reduced by that much. So now, okay, if you talk to classical economists, they'll tell you, oh yeah, but that's not really a problem because, that money would then reappear in the system in the form of investment. Except that in practice, this doesn't really happen. So what happens in the system is that you have a deflationary gap, meaning the aggregate prices of goods and services are here, and the total purchasing power that comes for them is here, right? Because some of the money is withdrawn for repayment of credits, some of the money is retained in savings. So now what has to happen is that all the producers, all the entrepreneurs have to lower the price in order to sell all the goods and services in the market, or they have to do things like reduce the capacities or let some people go, reduce productions, and so forth. So what happens in practice is that you get a thing called a deflationary deflationary death spiral, right? Because if the producers and the sellers lower the prices, they may need to reduce their output. They may need to let some people go. The result of that is further reduction of the purchasing power in the system, which means that in the next cycle, there's going to be even less purchasing power to absorb the production of the system. So you get this deflationary death spiral. And if an economy is left to itself, then it will only stabilize at the depression level of activity, meaning that it will continue producing the necessities of life, but it will not be able to systematically grow every year, and because of the way this monetary system is conceived, economies have to grow every year. There's, as everybody knows, there's among the policymakers, there's this obsession with economic growth, even though if you do a math curve, you see that you can't grow forever, 2%, 3%, 5% a year. It cannot, because it's an exponential curve. So at some point, growth will level off. So today, no government in the world will allow its economy to stabilize at depression level of activity, because they'll be voted out of office, because people want prosperity, people want full employment, and so on and so forth. And so what happens in practice is that governments have to step in. And it is not sufficient for governments to tax people and then spend it in the economy. That simply shifts the purchasing power from one buyer to the next, to another. So it shifts purchasing power from consumers to the government, and then it, instead of people buying restaurant meals and clothes and apparel and cars, government buys government pet projects, including goodies for the military industrial complex and the big pharma and the big ag and the big tech and so forth. But the government steps in. And you can look at any curve of any government, you look at their deficits, and you look at their debts, and you see that over time, reliably, without exception, the debts and deficits go up to staggering amounts even. And that is, regardless of politicians who come to the electorate and they promise, oh, we're going to balance our budget, we're going to cut spending, we're going to, reduce debts. It never happens. And it never happens for decades. Anybody who promises that they're either lying to the electorate or they don't know what they're promising. Now, where do we get to the socialism versus capitalism idea? because the government has to take on debt and spend it into the economy, you have socialism either way. Except that in the countries that we today call socialist, government largesse usually flows bottom up, meaning that a large chunk of all that money that the government pumps into the economy to maintain the purchasing power is distributed to ordinary people, as free healthcare, free education, generous pension plans, social support, things like that. In nations that we call capitalist, the same thing goes on, except the money is pumped into the economy top down. So the governments give tens, hundreds of billions of dollars to big oil and big ag and big pharma, large universities. It all flows top down, and much, much less of it flows bottom up. So the difference is not that you have in one case you have free market economy with small government and little interference from government in the economy. You have big government in either case. It's just that for whatever ideological reason, one kind of government chooses to splurge that money bottom up and the other one top down. And then we can see the effects of those societies, because where governments distribute the money bottom up, people individually choose how they're going to spend that money. So, maybe they go to the hair salon, they go on vacation, they buy a new car, they eat, they buy good food and so forth. Whereas if you spend it top down, money ends up allocated to the military-industrial complex and to the big corporations of all kinds, and that has a side effect that it tends to give rise to fascism, because these large corporations become more and more wealthy and more powerful. They gain the clout, enabling them to put pressure on governments. And if you spend $1 trillion a year on military-industrial complex, sure enough, they're going to find wars that they want to fight, and they're going to, pressure the government to let them have those wars, and then you get the state of permanent warfare. And anyway, the ideological tug of war, where these, people who call themselves card-carrying capitalists absolutely despise socialism because they perceive it as the government giving money to the lazy and undeserving people. They're wrong on two counts. Their governments, capitalist governments, do the same, only they give it, it's instead of welfare, it's corporate welfare. And the second thing is that if you don't do that, you end up with a lot of impoverished people. And so, even if you're a cold-hearted capitalist and you have investments in companies, restaurants, hotels, whatever, wouldn't you prefer that all those undeserving, lazy people have money to spend, and then maybe they come and patronize your business? They come to your hotels, to your restaurants, they buy your products, rather than them being on the street, homeless, dragged out of their heads and become a threat to your maybe children going to school and back home. So, what I'm advocating is not socialism or capitalism. What I'm advocating is that we try to analyze the systems according to what they do in reality, rather than according to what the ideology tells us that they ought to do. And so, I find all these, Austrian economists and people who worship at the altar of Friedrich Hayek and Murray Rothbard, they don't take any of this into account. They're guided by the ideology that has been nicely formulated and packaged for them in Road to Serfdom and all these other books, which they're nice when you read them, but look at what happens in reality. Find me the small government that doesn't interfere in the economy. Find me the government whose budget deficits haven't ballooned over the years. Find me a government in the world, whether it describes itself as capitalist or socialist, that doesn't have ballooning debt. The United States, the mothership of free market capitalism, has nearly $35 trillion in debt, way over 100% of the GDP. How did that happen? So, we have to focus on what systems do. And I think that we have enough knowledge and information today and analytical tools and collaboration online that we should be able to upgrade the operating system of our economies to the greatest benefit of everybody. Because even the coldest of the cold-hearted capitalists would prefer that their target markets are people who have money to spend rather than who are broke and on the street and, defecating around their neighborhoods as we see in more and more cities in the Western world.
That was a great breakdown. I want to switch to, speaking of the West in decline, the UK right now, because it's playing out like George Orwell's writing a new novel from the great beyond, as the UK police are now not only threatening their own citizens and following through on those threats, throwing people in jail for daring to post anything against the regime narrative. I think in this case, it's the large amounts of migrants allowed in. They're now threatening people overseas that if you're outside of the UK, it doesn't matter. We're coming for you too if you're posting and sharing these sorts of images and videos online. Obviously, this is complete insanity that this is even being allowed to be spoken. The EU as well, threatening Musk over his interview with Trump. They continue to push forward this agenda of combating misinformation. They're putting together commissions about it and trying to shut down free speech on the internet is what it appears to be what they're doing. Where is all of this headed? Why are they doing this? Is this a desperate act that they're kind of losing their grip on power, and so the next step or the narrative is not in their control, and so the next step is to just kind of ram into the wall and take everybody by force? Is this the desperate act of a dying animal, or is this something more diabolical for a long-term plan? I mean, how do you read into all this?
Yeah, I think you're on the right track. It is a desperate act of a dying animal, but it's okay. So I've done a little bit of research over the last few days because I publish a daily market report called the iSystem Trend Compass, and on Friday I wrote something about how Britain all of a sudden has moved into V for Vendetta territory. I don't know if you've seen that film, but the film was made in 2005, and it shows England in this dystopian future where there's a totalitarian regime in charge, and they're extremely repressive to the people. And then if you watched the statement by some of these police commissioners in Britain and Keir Starmer and some of the journalists appearing on these corporate networks, the rhetoric has shifted surprisingly to the V for Vendetta territory. And so I wrote this in my market report, and then the same day in the evening, I did a podcast with Tom Longo, and we kind of discussed this, and it turned into almost like a little bit of a brainstorming session. And we came to none of this is new in Britain, So we had the stabbings of 3 beautiful little girls in England on 29 July, and immediately the narrative directed the blame towards the Muslim community, even though it wasn't a Muslim who has committed those murders. And then we had, all these reports about the riots happening all over England, supposedly the Muslim immigrant community clashing with these white, kind of right-wing patriotic Englishmen. But a friend of mine told me I'm in London and everything seems normal. It's calm. And then, he told me, like, I talked to a number of my acquaintances and friends in other cities, even where these riots were reported, and they tell me the same. It's kind of calm. So it seems that the government and the media exaggerated the the tensions, the social tensions. And if that's true, which apparently it is, it would seem that they exaggerated it to justify a crackdown, a very draconian crackdown on free speech and against protests. And then, like with Tom, we would say, like, why would they do this? And why now? Obviously, immediately you start suspecting that there's something going on in the financial system that's about to implode. Something's wrong. And so I started digging a little bit, and so it seems that Britain has gone in over its head in Ukraine. They've been the cheerleader in this world for war against Russia in Ukraine. And they've been a major sponsor of it. Except that since as far as financing the Ukrainian government, so Britain has guaranteed multiple tranches of World Bank loans to Ukraine over the last 2 years. Private investors like BlackRock and Amundi and some other people have loaned something in the neighborhood of $20 billion to Ukraine. But since the beginning of the special military operation in 2022, Ukraine's GDP has collapsed by 25%. Militarily, they have failed, and they are on the verge of losing. And so these private bondholders have had to freeze Ukraine's bond repayments for 2 years. This happened in July 2022. Except that this freeze expired on the 1st of August this year. And these bondholders were extremely keen for Ukraine to restart paying at least servicing the interest on those debts. But it appears that if Ukraine starts to do this could completely capsize it. And so what happened is here's what happened in July. Between the 12th and the 19th July, there has been this negotiation between a group of private investors and the Ukrainian government. And so the Ukrainian government was demanding a 65% reduction in their debts, and the private investors were offering 22%. On 22 July, they finally agreed to a 37% haircut for the investors. But this was just a preliminary agreement between Ukraine's government and this ad hoc committee of investors that was, I don't know, the Rothschilds were involved in some law firms in London. Anyway, they came up with this agreement, they drafted it, but then what was supposed to happen next is that Ukraine's government was supposed to immediately begin the process of restructuring its debt, swapping old debt for new debt at new terms. They haven't done it. And then they were supposed to go to all these investors who have bought various tranches of these bonds and to solicit acceptance. So what happened is that on the 18th July, Zelensky went to London, where he met with General Valery Zaluzhny, who was his commander-in-chief. And then he attended some European politics summit. I don't know. There were representatives of 40 European governments. And that was the day the next day was the last day of these negotiations with the private bondholders, the creditors to Ukraine. On the 19th, so 19th was the last day of those negotiations, which was also the same day when Zelensky, on the second day of his visit there, had a meeting with Keir Starmer, official meeting with the Prime Minister and the whole British cabinet, and he he got the honor of addressing the British cabinet, which is the first time that happened since 1997. The last time that happened was Bill Clinton addressing Tony Blair's cabinet. And so the bonds deal was announced on the 22nd July, right after Zelensky's visit. That's when the press release was published by London Stock Exchange, supposedly drafted by Ukrainian government, by the Ministry of Finance. And basically what happened is that the Ukrainians were demanding a 65% debt reduction. The creditors were offering 22%. They finally settled at 37%. But the Ukrainians were supposed to then immediately proceed with restructuring those debts and soliciting the bondholders, because this was a preliminary agreement with an ad hoc committee of these investors. They were not making the decision on behalf of all the investors. So the Ukraine's government was supposed to go and restructure these debts and then offer new bonds for the old bonds to all the bondholders. And they were even offering a consent fee, something called like the consent fee of 1.25% to encourage investors. But the Ukrainian government didn't do this. What happened instead is that on the 24th of July, Fitch Ratings downgraded Ukraine. And there are two very important elements to this Fitch rating. Normally, there's a protocol in place when, ratings agencies rate sovereign governments. It's done on a given date. So, the next, credit rating review for Ukrainian government was set for December 6th. And the fact that Fitch issued a credit ratings review on 24th July was because there was a material change in Ukrainian government's financial position and a significant deterioration. So they downgraded the country from CC to C, which is practically unheard of for a government. And it reflects that the government has entered into a process of default, which is explicitly stated on Fitch's credit rating downgrade. So 31st July, a week after that, Zelensky signs a decree that allows Ukraine's government to suspend all debt payments for a period of 2 months or maybe 3 months. I read two different accounts. And so that buys them 2 months. But it doesn't change the fact that their financial situation is now catastrophic, and it's probably an irreversible process of debt default. And it seems to me that the side that is most heavily on the hook is Great Britain, because Britain has, among other things, the British government has guaranteed multiple tranches of World Bank's debt to Ukraine. British government has donated at least £3 billion. No, sorry, a lot more than that. Close to $7 billion, close to $7 billion in military aid. And another more than $5 billion in fiscal, financial aid, and these money allocated to reforms and humanitarian aid and whatnot. So Britain is on hook for tens of billions of dollars. Clearly, we don't know who, but government is part of it. Bank of England might be on the hook. A lot of British pension funds, hedge funds, private investments are probably on the hook. And so it seems to me that Ukraine's default is now a critical event for the British financial and economic system. And so what has happened over this same time period, the last 2 weeks of July and end of July and beginning of August, when there's been this flurry of activity related to Ukraine's debt repayments. We had on the 29th July, we had those stabbings in Southport, which apparently triggered all these riots that apparently then justified government crackdown on free speech and protests. We also had, I think on the 6th of August, Ukraine launched this incursion into Kursk. And this incursion was also presented to the Western media as a great success of of Ukrainian military. And then it justified the Council of Europe approving $4.2 billion in financial support to Ukraine. This money was going to be allocated anyway, but I think that it was brought forward, that it sped up the process of approval and transfer of the money back to Ukraine. So they bought themselves a little bit of time. But I think that Ukraine is going to default and they're going to drag Britain along with them. And then another confirmation of this is because that same 22nd July, when they announced the deal with the bondholders, the Bank of England also announced some seminar where one of the Bank of England directors, her name is Saporta, I forget the first name, regardless, made a speech. So on the 22nd July, they announced this speech, and the speech happened on the 22nd July. And the title of her speech was, "Let's get ready to repo." And the gist of it is that the Bank of England would have to accept a much, much broader range of assets as money good collateral against which it could issue credit to British banks. What that means is that, any old junk may count as money good collateral to justify Bank of England flooding liquidity into the system to stop it from seizing up altogether. What that ultimately means is that we're going to get reacceleration of inflation in England, in Britain, that we're going to have disintegration of the British pound and of the whole financial system, and probably slow motion train wreck of a collapse of the British pound, which might even be fast. I don't know. You can't ever predict the pace of these events, but obviously a lot has been going on as the background to what we see in the media, that Britain is turning into this V for Vendetta authoritarian tyrannical system where people can get arrested for posting the wrong thing, for thought crimes. I mean, they've arrested people on the street. They interrogate them. Are you standing here praying? What are you doing? Why are you here? So, and if the person can't justify why they're standing there on the public venue, they pick them up. There's been over 1,000 arrests. There's been draconian sentences handed down to people for posting things on Facebook and Twitter. And now apparently they want to be arresting people abroad and having them extradited to England for thought crimes. I mean, who would have thought that such an Orwellian development would come like that so quickly? Unless you were paying attention, this might come as a surprise, but it's been long in the making. The reason why it's gone total at this time, like it's like Starmer government stepped it up so radically, I think is because there's a ticking time bomb in British financial system. One or more of the banks is on the verge of collapsing. And, keep in mind, Britain doesn't have a very robust banking system. I think something like 90% of all deposits are with the big five. And if one of those banks fails, it's probably going to pull all of them with them. And so there's a risk that the whole system comes to a grinding halt, which is why the Bank of England now has to accept any toxic sludge as money good collateral to print up British pounds and flood them into the system so that it can keep ticking along.
Wow, very interesting breakdown. It raises so many more questions. We're out of time today, but we'll have to have the discussion at another time. Some questions that come to mind are, is Putin out there playing, 12D chess and actually is aware that extending operations in Ukraine is going to pull more and more money out of the West until it kind of collapses on itself, as in this situation, and also how the British government is planning to use this new authoritarian Orwellian system to find a way out of the mess they're in. This is also fascinating. So I really appreciate you coming on, Alex. For those who want to hear more from you, talk about Krainer Analytics. You've got the Trend Compass newsletter. I'm a subscriber to the free version of your newsletter. It's one of the few that when it hits my inbox, I always read top to bottom. Find it really fascinating. So tell us about that. Krainer Analytics, anywhere else you want to direct people online.
Yeah, so it's easy to find me on Twitter. My handle is @NakedHedgie. My Substack, which is free, is Alex Krainer's Trend Compass. And I publish there generally, things more to do with history, economics, geopolitics, and things like that. For investors and traders, I publish daily iSystem Trend Compass, which basically generates CTA, trend following buy and sell signals for a total of about 200 markets that we track. And so that's not free. But nevertheless, I may as well say that I'm looking perhaps to publish, let's call it a no-frills version of that same newsletter and those same signals on Substack in the near future. So there's going to be another Substack publication that's going to be communicating these trading signals for stock indices, treasuries, currencies, probably also gold and silver, and possibly things like crude oil and Bitcoin. And so that's probably a few weeks from now, but there's a number of newsletters that are available for subscription already, and there's always a free 1 month free trial, and there's no strings attached. People just sign up. They get a free month trial, and then at the end of the month they get to decide whether they want to subscribe or not. There's no jumping through hoops to cancel the subscription.
Great. Well, I'll put links to all of that in the description below for people who want to check it out. Thank you once again, Alex, for coming on the show. It's been a fantastic conversation.
My pleasure, Jesse. I enjoyed it. Thank you.
And thank you for joining us today. As a reminder, this episode was brought to you by ARC Silver Gold Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.